Hello everybody, welcome to my channel. Let's look at Amazon stocks today following Q4 2019 earning results, and the values that I will be using and presenting you consider a current share price of $1,900 at the moment. So let's dive in. The presentation will be split into different steps. I will be looking first into the three major components of the earning results, which are income statement, balance sheet, and cash flow statement. And based on these three sections, I will present you an identity card, basically that summarize everything, and will give us like more, let's say, knowledge to decide whether we want to invest or not. At the end, I will also finish with a comparison with Walmart, because we always compare Amazon with Walmart, but it's interesting to compare the metrics to really have an idea of which one would be the winner for the next years. So let's dive into the income statements, and basically I want to present and start this income statement with a split revenue per sector for the company over the last 3 years. I took these values from the last 10K, sorry, and just to have an idea of which sector is growing and how much it is growing. As you can see, most of the revenue on the last 3 years was dominated by the online stores and the third-party sellers. Other components, very minimal, like the subscription service, the physical store, and the Amazon Web Service represent a minimal part of the revenue. However, this revenue doesn't show exactly how much gross margin each of the sector is generating. And actually, the online stores have a very lower gross margin than for example, the Amazon Web Service. And basically they generate as much as each other, like both of them generates a similar amount of, let's say, net income. That's why it's interesting to look at the different growth of each of the sector. And as you can see, Amazon Web Service is already and still at a very, very high growth, plus a 40+% growth year over year. So don't get fooled when you get just a revenue increase, a total revenue increase for Amazon around like 15–20%, because this is just a general revenue growth. What we need to look at is the sectors that are giving a very high gross margin and that are still contributing to the net income. So that's the first presentation. The next part, I like to share these last 4 quarter graphs related to the margins, revenue, and OPEX split, just to give you a feeling of how the numbers are evolving. Okay, so what you can see here, the gross margin first, just took a little bit of hit on the last quarter, probably during the, let's say, winter season, which usually is like a discount period. But over the last years, the gross margin has always been increasing, like for 20 to 25, 30, 35, 40. But this year is like quite stable and decreasing slightly. So this is a metric that we will have to monitor over the next quarters. Okay. For the revenue here has been increasing quarter over quarter. So this is a good sign. They have also a positive net income for each of the quarter between 3 and 6%. And also the OPEX split is very interesting because it's showing how much the company is investing into the future. How do we know this? Is when a company is investing more than 10% of the total revenue, usually you can consider that this company is very heavily invested into research and development. This is for us very comforting for the revenue growth, and also for this compound growth. It means that a company doesn't invest into buyback or paying a dividend, but prefers to invest into organic growth. And this is super important. Now, let's look at the balance sheet. So to present you this, this graph actually includes the last 4 quarters figures. So as you can see, for each item, here is the legend. Each of the tick represent the value for each of the last 4 quarters. So Q1, Q2, Q3, and Q4. In this way, you can have a more dynamic vision of the balance sheet to see what is changing and what is, let's say, what can be like a sign of warning. So let's start first with the long-term liability. What I see over the last 4 quarters, an increase of $10 billion. I could also see an increase of around $20 billion of current liabilities. So these first two items are not a very good sign. However, you can see that they invested a lot into plant, property, and equipment development and invested almost like $15 billion into these hard assets. Probably the new office in India and then some more warehouses. Also, what is important to look at is the liquidity. So all that is pink is part of the liquidity of the company. Inventory has slightly increased, receivable also, and the cash equivalent has highly increased, probably due to this increase of current liability. Is definitely not cash and equivalent produced by operating cash flow. Now let's compare apples with apples. What is interesting to look at is compare the short-term assets. So these are the percentage here of the book value. Okay. What is interesting to look at least for the short-term vision, is to compare the short-term asset with the short-term debt, current liabilities. And as you can see, they have enough liquidity to cover the current liability. So this is the main point we have to look into. Okay. Let's go next to the cash flow statement. I present you here two different graphs. A quarterly graph, which gives you cumulative values for each of the three operating, investing, and financing subdivisions. And here this is the same legend for the yearly basis from 2016 to 2019. What I like to see here on this cash flow statement is a positive operating cash flow that is growing, which is the case for Amazon. They went from $17 billion to $38 billion of operating cash flow. This is really, really strong. The second point I like to look at is the investing part. As you can see, it changed quite significantly year over year. Is because they have two components into this investing. First is the CapEx. CapEx, as you can see here for the last year, 2019, is 16 billion. And the other part that is generating, like fluctuating, is the investing, let's say, part when they acquire a company or like sell a part of the business. That's why here, actually, I can give a quick detail on 2019. Investing part was 7 billion. Next part I like to look at is the financing. What does the company do with the financing part? Here you can see that the financing part is negative for the last 2 years. And the reason why is not that they are paying dividend or paying buyback, is simply because they try to reimburse a long-term debt. Okay. All these values, you can get them on the 10K report on the website called sec.gov. Next part is looking at the shares outstanding. Usually I look at this when I have a look at a very like a small company, a small growing company, which sometimes is diluting a lot of shares. This is not the case for Amazon, which is just diluting the shares by 1% every year. So it's not very, let's say, relevant to look at this for Amazon. Now, based on these three subdivisions, so income statement, balance sheet, and cash flow, I put most of the data into this table so that we can basically calculate a yield return for this company. The way I do this simply is, so these are the three main, let's say, values that we need to look at for the graph. The first is that I look over the year how much the company made as earning and how much depreciation they had to declare. To me, the free cash flow is basically the subtraction of earning subtracted by the depreciation, which gives you a negative value. So as you can see here, I divide the free cash flow by the enterprise value and it gives me like the return of the company. Here at the moment, the company is not, let's say, profitable, which we know that Amazon has not been profitable for many, many years. And I do the same exercise, but just considering the earning, considering the earning just for the last quarter. And it gives me around the same yield return of a -1%. Be aware that this includes a lot of reinvestment into research and development. So I like to see also how much the company would yield if it didn't invest so much. And I end up with a value of 3%, which is still good. So it means that the company usually is profitable, but it spends all its net income back into research and development. So I like the concept. I like the approach of Jeff Bezos. Now let's look at the value metrics quickly. Price to sales, EV to sales. They have a decent value compared to the gross margin. I like to compare, let's say, if you have like a 40% gross margin company, the EV to sales has to be 4. It's like a proportional metric that I apply just to have an idea if it's decent or not. So for me, the valuation is not so bad, but the price to cash is not so good. If it's more than 10, you know that the company doesn't have too much cash in hand. When you look at the debt also, this is one point that I pay attention a lot, is the ratio of long-term debt divided by the yearly earnings. It gives me an idea of how many years the company will have to work to reimburse all the long-term debts. And it's equivalent of 6.5 years in the case of Amazon. Usually, Warren Buffett recommends a ratio of less than 4. If the company gets more debt than like this ratio of 4, it means that it's already in the red zone. So this is not a very good point for Amazon, but this is a company, let's say, very smart in terms of growing, and they probably get this debt for a good reason. Next point I want to highlight is look at the different operating revenue per employee, which gives me an insight of how efficient is this company. And this value is in the average, okay, between $100,000 and $200,000 per employee per year. This is an average value. What I don't like is to look at the cash per employee, especially during this crisis. Let's say if the company has no more revenue, how much money is available to pay the employee. And as you can see here, it's really, really little money. But let's not worry too much. We know that Amazon is going to surf on the wave of the crisis and are still very busy hiring more people to satisfy let's say, the customers. Next point I'd like to look at is, and is one of the most important, is the comparison between revenue growth and OPEX growth over the last 3 years. As you can see, over the last 3 years, Amazon grew 106%, which is massive for already such a big company. And the OPEX growth, also I compare it, and it grew 131%. So as you can see, there's no operating leverage. When the revenue grows, the OPEX grows even more. So it means that the company, if it continues in this way, the company will have less and less let's say, net income generated from its operation. So this is also something we really need to look at, to pay attention, how much OPEX grows in comparison to revenue growth. Okay, so now that we have this identity card, I would like to do the same with Walmart and to compare these two companies. People compare really like face to face this company and then sometimes give an advantage to Walmart. But I just try to look at the numbers and not to, let's say, make any supposition or opinion or speculative thoughts. What I just compare here is I like to compare these 8 different values taken from the identity cards. And what I look first at Walmart is that they have a very little cash per employee. They have a very little, let's say, revenue generation per employee. Also, the revenue growth is quite minimal over the last 3 years, only 8%. And then you can see the yield return, if you remove the R&D, actually is less than Amazon. Because if you look into the income statement of Walmart, they don't invest $1 into research and development. Okay, so I compare basically the free cash flow to the EV, the revenue growth, the net margin, the leverage percentage, so which is equivalent to the revenue growth minus the OPEX growth. I compare the operating revenue per employee, also the long-term debt per earning, per yearly income, and also the retained earning divided by the market cap, and finally the cash per employee. And I summarize for each, let's say, of the winner, I put 1 point for each of the company, and I end up with Amazon winning the contest, 5, and Walmart only 3. So let's go into the conclusion. And what I like to look at here is what is like the pros for the company before investing in such a company. What I like to look at is the first good point is the research and development budget, which is the biggest in the world. I clearly don't lie on that, is $36 billion for 2019. I added a small graph here just to give you an idea of how much Google is investing, Microsoft, Apple, Facebook, and IBM, to give you just an insight of how much Amazon is investing into the future. In 2016, Amazon was only putting $17 billion into R&D, and now it's 36 billion. The second one, Google, which is a huge company, is only putting 26 billion into research and development, which is like already 10 billion less than Amazon. So to me, this is a huge, huge contributor of, let's say, the hidden value of Amazon, is that they could already generate so much cash, but they still invest a lot and a lot and a lot to make this compound growth. So here I just put a detail of the 10K if you want to have any idea of what they are actually investing in this R&D. They mention as technology and content. So if you are interested, you can read this little paragraph. Let's go back to the conclusion. So what is important also to see is the segment of Amazon Web Service that is still growing at a 40+% pace, and this is super, super good news. The other point is the massive opportunity for Amazon to develop into India country, and we know that is a very, very huge market. They have a little bit of issues to come inside and to apply this marketplace business because of rules, but I believe they will be working on that over the next months, years, to be able to make their business. Also, the crisis. What will the crisis make to Amazon? Will be positive, negative? I believe all the competition that is already in a little bit of orange red will be definitely drowning into this crisis, and it will probably bring more customers to Amazon on this online business. We know also that Walmart is investing heavily into these online stores. But basically, as I mentioned, they have a lot of debt, very little cash to invest, and I believe over the next months and years, Walmart will give customers will switch to probably to Amazon. This is my point of view, just my opinion. And to finish the cons of the company, not too much liquidity at the moment, so they already have a lot of debt. Uh, um, so it makes the company, let's say, in a position that will not benefit from the crisis to make like cheap acquisitions. And for this reason, it's for me this is the only, let's say, wrong point. However, they can still cut a little bit into the budget of research and development and maybe do smart moves from to generate more cash and make some interesting acquisitions, if any. So I think that's it. I hope you enjoy. I don't know if you're still watching the video. I think you are very courageous. But if you have any comments, let me know. Let me know on the comment section. If you have any suggestion for companies or any comments regarding this Amazon that I may have forgotten, just let me know and then I will come to you back. Thank you very much and see you on the next video. Bye.